Hello and welcome to Chapter 3, Engagement Planning. In this chapter, we're going to spend some time talking about considerations that the auditor has to make at the beginning of the audit in terms of the procedures that they are going to perform, the individuals who are going to perform the procedures, and exactly when they're going to perform the procedures. We're then going to get more into the nitty gritty of exactly what an auditor does. So, what are these procedures that an auditor is going to perform? What kinds of evidence do those procedures collect? And then finally, we're going to end with documentation of the procedures and working papers, who owns the working papers, what are the retention requirements, and etc. So, the first learning objective deals with understanding what are the required pre-engagement activities that an auditor needs to undertake before they actually begin the engagement. So there's 5 general categories. There's client acceptance and continuance. There's communication with the predecessor auditor. There's compliance with independence and other ethical requirements. So if you remember back to Chapter 2 and when we talked about gas, we said that an auditor is required to be independent with respect to the entity that they're auditing throughout the audit. So we need to consider that as before we start the audit to ensure that we're actually independent with respect to the entity and that there won't be any issues in the future. We're also going to speak about engagement letters, which are required communication with clients. It's essentially your agreement with clients, as well as termination letters. So first, communication between the predecessor and prospective auditors. You need to attempt to communicate with the predecessor auditor. The client has to give you permission to speak with the predecessor auditor. And similarly, the predecessor auditor has to get the client's permission to speak to you. So both auditors need to go to the client to get that permission before that they can have a frank discussion about what's going on with the client. And you might say, well, why is that? And the reason is because under the professional standards, client communication is considered confidential. And so auditors cannot, and we will talk more about this when we talk about working papers, auditors are not allowed to just disclose anything that they want with regard to their clients. But this communication is mandatory, so you're supposed to at least attempt. Now, what can happen? Well, what can happen is the client can say, no, I don't want you to speak to the predecessor auditor. As someone who owns a business, if you're, say, a sole proprietor or you're a partner for a big accounting firm, and you're considering whether you want to accept a client, if a client is not willing to let you have these frank discussions with the predecessor auditor, you should be incredibly skeptical as to whether you should continue with the client. That is a huge red flag that they would not want you to speak with the predecessor auditor. So it says you need to attempt, but in all reality, you need to have those discussions. And if a client will not allow you or will not allow the predecessor to speak with you, then you need to probably withdraw from the engagement. So, well, it says attempt, and in all reality, you need to have those discussions. So, what are some things you're going to discuss? Things that you'd probably guess: disagreements about accounting principles or audit procedures. So some clients do not like certain audit procedures. They may not want you to, say, send out accounts receivable confirmations to their customers because they don't want to bother their customers. They don't want you to do inventory counts at certain times because they feel like it interrupts normal business operations. These are things that you're going to want to know as the auditor, because some procedures, such as accounts receivable confirmations, are required by GAS. And so if you're not performing them because the client doesn't want you to perform them, that can be an issue in terms of your own quality control for your audit. And if say the business fails and the company is being liquidated and they're being sued, you're probably going to get sued, because what the people will say is, well, this auditor was not exercising due professional care. This auditor is not doing what all other reasonable auditors would be doing in this situation. So you want to make sure and understand if they have, aggressive attitudes towards accounting principles, or if they object to certain audit procedures. You also need to have a communication, obviously, about any kind of fraud, illegal acts, and internal control issues within the company. And this is just going to help you more than anything figure out, particularly in the planning phase, which is what we're talking about, what procedures are going to be necessary to make sure that you get sufficient appropriate evidence as required by GAS. And then also we need to understand what the predecessor's auditor's understanding is with regard to why they lost the client. Was it an issue of staffing? Did they choose to end the relationship? Did the client choose to end the relationship? Why exactly do they believe that they were let go by the client, or why did they withdraw from the client? Now, this again is really critical in terms of making that decision as to whether you want to accept a client or whether you want to continue with a relationship with the client. Because if what the predecessor tells you is, well, the reason why I left the client is because they were always trying to, hide small misstatements in several accounts, and when you would aggregate them up, it would be material, and it seemed to me to be an attempt at fraud, but I couldn't really prove it, but I didn't feel comfortable with the client, so that's why I didn't want to be involved with the client. As the successor auditor, if they did that to the predecessor, they're probably going to be trying to do the same things with you. So you want to make sure and have a full picture of exactly how the client is before you accept an engagement. One of the things that we don't get into in this class, because we do not cover the legal liability of auditors, but we talk about it extensively in the graduate audit course, is the fact that when a business fails, there's often nothing left for people. So creditors, investors who've lost a lot of money, there's nothing left to get. The company's liquidated. There's no company around to get any money from. So oftentimes the only party that's left is the auditor. They're the only solvent party where someone can say this person was associated with the company, they have money, they didn't do their job, we want to collect money from them. And so because of that, anytime a business fails, the auditor is almost always going to be sued. Now, whether they're successful in suing you is a different story, but you're probably going to be sued. So to avoid those issues, what the auditor should do is really consider clients and consider integrity issues, fraud issues, how did they interact with their previous auditor. All those things are considerations you want to make before you accept a client, because when you accept a client, it's possible that one client can cause your firm to fail. So the best example of this is Arthur Andersen. Arthur Andersen had thousands of clients, but it was one client in particular, Enron, that ultimately led to that firm going away completely. And so you need to be really careful when you accept clients because of the litigation risk that it poses. So communication with predecessors is absolutely critical. You also, as we discussed in Chapter 2, you need to make sure that you're independent and that you're going to be able to exercise appropriate due professional care. So again, we need to maintain independence and mental attitude for independence in fact as well as independence in appearance throughout the engagement. So why is this important in the planning? Well, one of the things we need to ask is, could there be a perception that we are not independent with respect to the entity, as well as are there issues with people who work for our company that would lead to an independence in fact infraction? So what do I mean? Well, what I mean is, let's say that we decide to start auditing a publicly traded company, and certain members that we plan on having on the engagement team own shares of stock in that entity. That's a violation of independence in fact. We cannot have a direct financial interest in a client. So we need to make sure that before we start the engagement, anyone who is going to be working on the audit no longer owns shares of stock in the company. And there are a lot of other considerations in terms of independence. And that's part of the professional standards discussions that we have in the graduate course. But there are a number of other considerations in terms of independence in fact and whether we are actually independent. Similarly, we need to consider independence in appearance. So, for example, if a former partner within our audit firm is now working as the CEO or CFO of the company that we're considering starting an engagement with, there may be an independence in appearance issue. This can also be an independence in fact issue if we're talking about a publicly traded company, because for publicly traded company, there's now what is called a cooling off period where members of the engagement team cannot work in what's considered an audit sensitive area for more than a year. So these are considerations that we need to think about, again, during the planning before we're actually starting any kind of audit work in terms of the planning and the acceptance of clients. And the reason why this is important is because a lack of independence can result in disciplinary action as well as litigation. So we may get our licenses suspended and we can be sued. And these lawsuits can be extremely costly and bankrupt a firm. Engagement letters. So engagement letters, anytime we have a client who we've accepted, even when it's year to year, we need to have an engagement letter. So what is an engagement letter? Well, an engagement letter is just the contract between the auditor and the client. And so this is going to help us reduce the risk of any kind of misunderstanding. And it's also going to help us if we do get sued in the future. So what we want to really clearly state in this engagement letter is exactly what we're doing, but also what we are not doing. And if you remember back to the definition of attestation engagements and audits, where we talked about that you are reporting on some subject matter that is the assertion of another party, that needs to be clearly specified in the engagement letter. Say, the company's management is responsible for these financial statements. We are responsible for conducting an audit of those financial statements. So you want to make sure that that's very clearly spelled out. So you're going to discuss what are the objectives of the engagement, what are management's responsibility. At a minimum, they're going to be responsible for the financial statements and internal control over financial reporting. For a publicly traded company, management is also required to assess the effectiveness of internal control over financial reporting, as well as our responsibility. So we're going to conduct an audit, and we will note any kind of limitations for the specific engagement. But engagement letters are required, and they're absolutely essential. Okay, in terms of planning, we need to have an audit plan. So what's an audit plan? An audit plan is just a comprehensive list of the specific audit procedures that we're going to perform. So we're going to discuss here in a moment what those audit procedures are. I use the mnemonic 5 carrots to help you remember all the different procedures that auditors perform. So what procedures are we going to perform? And we need to make sure that we plan so that we are able to obtain sufficient appropriate evidence on which to base our opinion. So if you remember back to chapter 2 and we talked about gas, that was the ultimate goal when we were talking about the field work phase, is to make sure that we have sufficient appropriate evidence. What does sufficient appropriate evidence mean? Well, sufficient appropriate evidence means that we have enough evidence that a reasonable auditor could conclude whether the financial statements were in conformity with GAAP and whether they're fairly presented. So we need to document a plan of what procedures we're going to perform to make sure that at the assertion level for the financial statements, we've addressed all of the relevant assertions. And so again, this goes back to chapter 1 when we talked about the assertions: existence, rights and obligations, completeness, valuation, and presentation and disclosure. We need to make sure that we are considering all of the relevant assertions for all of the major components of the company's financial statements in terms of our planning. So from that, we can start planning the nature, the timing, and the extent of the different types of tests that we're going to do. So in general, there's 2 broad categories of testing. There's control testing. So we want to see whether internal controls are designed and operating in a way that would help reduce or prevent or detect material issues within the financial statements. And we also want to make sure that we are doing substantive procedures where we are trying to substantiate how transactions are processed, as well as what are the ending numbers and are they appropriate and accurate. So there's really 2 buckets: control testing and substantive procedures. And we need to do enough of both of them to make sure that we have reduced the risks that the financial statements are misstated to an acceptable level. So when they discuss the nature, timing, and extent, and this is going to come up again and again and again as we go throughout the course, the nature refers to the effectiveness of the test that you're going to perform. Some tests are more effective than others. The timing is exactly what it sounds like. When exactly are you going to perform whatever the given test is? Are you going to do it at the beginning of the year? Are you going to do it throughout the year? Are you going to do it at year end? Timing affects how appropriate the evidence that you're collecting is. Some tests should be done at interim periods. Some tests should only be done at year end or after year end. So nature and timing both influence appropriateness because they're dealing with the quality of the evidence that you're collecting. The extent deals with the sufficiency. So if you remember when we talked about, okay, the evidence that we're going to collect, it needs to be both appropriate and sufficient. Nature and timing deal primarily with the appropriateness. Extent is dealing with the sufficiency or the quantity of evidence that we're going to collect. Staffing the engagement. So we're usually going to have a partner. Well, we should have a partner. We should have an audit manager. We may have an audit IT specialist, so someone who works within the audit firm that is our expert on information technology. A tax partner to make sure that all of the presentation and disclosure and other issues revolving around tax for the client are appropriate. Some kind of quality assurance partner. This is sometimes called a concurring partner, or these partners are not part of the regular engagement team in the sense that they're doing detailed work. These second partners or concurring partners are people who are coming in after we've done all of our procedures, and they're basically reviewing to make sure that the major judgments that the lead engagement partner has made are reasonable. And they're also looking for major presentation and disclosure issues within the financial statements. So they're kind of coming in, doing a high level review of the financial statements to make sure that we haven't missed something that's important. And then obviously the audit staff. So the staff is going to do the bulk of the detailed or granular work, and then it's going to work its way up from the staff to the manager to the partner. So for a new client with complex transactions and for public companies, we're going to want to staff that engagement with more experienced staff members. And hopefully this makes sense. So if you remember back, one of the things that we need to consider was competence and capabilities, as well as planning and supervision. And so we need to make sure that for engagements that are a little more risky, such as those where the company engages in a number of complex transactions, and for publicly traded companies are always more risky than non-public companies, we want to give ourselves the best chance of detecting any kind of material misstatements that are going to occur, and that's usually done by having people with a little bit more experience work on those engagements. Internal auditors are an important consideration as well. So we need to understand how the internal audit department works. What do they actually do? A lot of efficiency can be realized when we leverage what the internal audit department is doing. So for example, if the internal audit department extensively tests controls, we can leverage some of what they've already done so that we don't have to do as much work on those controls. Before we use anything that they do, however, we need to consider their objectivity and competence. So competence hopefully is straightforward in terms of your understanding of how we would evaluate that. That's going to be based on things like, what is their experience level? What is their education? What is the company's commitment to training those people? What professional certifications do they have? That's going to give us an idea of how competent those individuals are. Objectivity is typically assessed in terms of how the department is structured. So an internal audit department that reports directly to the CEO is not considered as objective as an internal audit department who reports directly to the board of directors. So we need to consider both of those in terms of how much we're going to use these internal auditors. So ideally, they're both objective and they're very competent. And then we can leverage some of the work that they've done. If we're going to use them, because they can actually perform some of the procedures that we need to do, if we are going to use them as part of the audit, they should not be delegated tasks that require professional judgment. They can do very routine, easy, non-audit judgment type of work. So they can help prepare schedules, they can help do things like prepare accounts receivable confirmations, but they cannot do things that require any kind of professional judgment. And so we need to be careful, and the reason why is because they are not, from our standpoint, independent with respect to the entity. So there's a risk that if there is something going on that we don't know about, they may be helping to hide it. And so we want to make sure and not allow them to do anything that would require judgment. But it's also a litigation issue. If we start letting them perform work that requires judgment, then we're going to be responsible for those judgments. So if we are subsequently sued and we let them make all kinds of high-level judgments, any issues with their judgment falls on us. It's as though they worked for us or they were part of us, and we don't want to have that. Use of other specialists. So these are specialists that are outside of the firm. So people who are specialized in things other than accounting and auditing. So, maybe good examples are people who are experts in derivatives or people who are experts in pensions. We need to, before we use one of these specialists, another good example is someone who's a specialist in, say, jewelry or diamonds. So we're auditing a diamond store and we don't have the expertise in terms of valuing the inventory, so we hire a specialist that can value diamonds accurately. Before we hire them, before we use them, we need to make sure and understand their qualifications, their experience, and their business reputation. Again, this is important because these specialists, because they are working under us, they're basically considered part of the engagement team. So if they make a mistake, we are liable for the mistake that they made. They are not. Well, they can be separately held. I guess they could. Someone could possibly sue both the specialist and the audit firm, but because of joint and several liability issues, we may be on the hook completely for their mistake. So we need to be careful when we use a specialist to make sure that they have a good reputation, that they're very experienced and very qualified before we use them, because we're ultimately going to be held responsible for their judgments. They should be unrelated to the company that we're auditing. They should be, but that does not mean that they have to be, because some specialists are so big and they have so many relationships with so many different groups. Sometimes it's unavoidable to have that this specialist would have a relationship with the client. And the good example of that is pensions. There's a few big companies that do pension valuations for a lot of different companies. So it may be difficult to find a specialist that is separate and completely unrelated. Now, obviously, the bigger they are, the less important any individual client is to that firm. So that helps mitigate some of that issue. But we should look for someone who's unrelated, but if they are not, we can still use them. A critical point in terms of the use of specialists is we need to be able to understand the methods that they used, the assumptions that they used to arrive at their decision, as well as what is the basis, which goes into what is the basis of their decision and of their judgment. So we should be able to, in other words, to evaluate their ultimate findings. We don't need to be able to do what they actually did. We just need to be able to understand the process that they used to arrive at their conclusion. And again, this is important because they are considered our subordinates. They're considered part of the audit team, and you wouldn't have a member of the audit team that was doing things that you didn't understand. You wouldn't have a staff auditor that was doing things that you didn't understand. So similarly, you should not be using a specialist that are doing things that you do not understand. Specialists are not going to be referred to in the audit reports unless we modify the report based on what they found. And so if you remember back to when we discussed different types of audit opinions, we had the unmodified or unqualified report, we had qualified, adverse, and disclaimer. If we qualify our opinion, if we give an adverse opinion, or if we disclaim an opinion, we may possibly refer to the specialist. And there's really technical rules about when we refer to specialists and when we do not. But just understand that we would not give, for example, an unqualified opinion on the financial statements and say this in part was due to the specialist that we used for this. You might say, well, why would someone want to do that? Well, what an auditor may want to do is include the fact that they used a specialist to make it look like they did a better job or a more thorough job. And as a profession, they've decided that that's not a good idea. So we restrict any kind of discussion about specialists unless the reason why you did not give an unqualified opinion was because of what the specialist found. IT auditors are critical, so some companies are, highly computerized. Maybe everything is computerized, and that's going to affect all kinds of things related to what audit evidence is going to be available. So we should have someone within the company that understands information technology and how it's going to affect the audit. We should also, just as with specialists though, we should be able to understand what they're doing. And we need to be able to supervise their work. So we should not have anyone that's working on the engagement team where the partner does not understand what they're doing. Again, this does not mean that the audit partner needs to be able to do exactly what they did, because there's a reason why we're calling this person a specialist, but they should have a general understanding of the process that they use to make their decision. And again, that's important for the partner because any decisions that are made below him are ultimately their responsibility. So you want to make sure that everyone that works under you, you understand what they're doing and why they're doing it and how they're doing it. Time budget seems pretty obvious. This is a business, so we need to make money, so we need to make sure that we're completing things on a timely basis. There's two big considerations of when we're going to do work. Are we going to do them at interim periods, sometimes several weeks or months before the balance sheet date, which is when we're going to do a lot of the controls type testing, and then the year-end audit. So what specific procedures are we going to do closer to year-end? There's some procedures that make sense to do only at year-end, such as inventory observation, accounts receivable confirmations. It's not to be said that those things cannot be done at other points in time, but the further you do, say, inventory observations or confirmations away from the balance sheet date, the less effective the tests are. And then lastly, time reports. We need to be reporting our time. This can be a very contentious issue when you're a new staff because you're required to keep very detailed records of your time. The advice that I give to people who are going to start as a staff auditor is to be very conscientious as to exactly how much time you really spent on the client. So if you were doing other things or you're checking email, you probably shouldn't be charging the client for those things. But similarly, you don't want to underreport time because that becomes an issue in terms of eating time, and what can happen over time is the budget can become unrealistic. So if staff auditors are always underreporting how long it took them to do things, what can happen over time is you can end up with a budget that says this should take 20 hours to do when it's really taking, say, 80 hours to do. And the next staff auditor who steps into your shoes may be, left holding the bag. So we want to make sure and accurately report time. The reason why you might see an issue in terms of eating time is because you're going to be evaluated on that. Partners are evaluated on their profitability. And if they have staff auditors who they're charging out at $100 per hour and they're working a ton of hours, it's going to make that engagement less profitable. So there's pressure that comes from the partners that filters down to the managers, which filters down to the staff, that they need to be more efficient. So they need to get things done in less time. And so that can lead to people eating time and underreporting the number of hours that they worked. But time reports are essential because we're going to use them for billing. and we're going to use them for planning. So we need to know how much to charge the client, and similarly, we need to know what to expect for next year. And so for that reason, accurate reporting of time is essential. Materiality. So we discussed materiality when we discussed gas, and so this is somewhat of a review of what we've already discussed. But materiality, again, is the amount that would influence a reasonable user of the financial statements. What would make a difference? The emphasis, again, is on the user rather than the management of the company or the audit team. One of the things that you will encounter if you were a staff auditor is the client will say, well, this is immaterial. And say, well, it may be immaterial to you, but is it immaterial to a potential investor or a current investor? So we need to focus on the end user as opposed to management's perceptions or even our perceptions. So in terms of setting materiality thresholds, we need to think, okay, would this be material to a reasonable user of the financial statements? So there's two broad categories. There's those quantitative criteria. What is the absolute size of what we're talking about? What is the relative size to other items within the financial statements? And what is the cumulative effect? So this is something I discussed a little bit earlier. If you have a bunch of quantitatively immaterial misstatements, but they're in every single account and they're all going in the same direction, when you aggregate them, the cumulative effect may be material. So we need to consider that as well. But we also have qualitative criteria. So what is the nature of the issue? If the issue was an error, it's less material than if it was clearly fraud. What are the circumstances? What is the uncertainty regarding something? So we need to consider all of those things in terms of determining, what is material, what is not material. Ultimately, though, materiality is a matter of professional judgment. GAS is in the interpretive publications. They're going to give you some ideas of quantitative thresholds of things to think about in terms of materiality. They're going to give you some qualitative examples of things that may be material, but ultimately it's up to the auditor. And what is the auditor's risk propensity? What do they feel is material and what is not material? But again, going back to GAS and thinking about, okay, what are the requirements? Due professional care is one of those. So in terms of determining what you think is material, you need to consider what a reasonably prudent CPA might think is material. And so narrowly putting it in the context of yourself and saying, oh, well, I don't think it's material, that can open you up to a lot of litigation. Because if everyone else would say it was material, then you could possibly be sued, and you can also lose your license, and you can lose a lot of money in the process. So we want to make sure that our professional judgments are consistent with what auditors are doing in general. So what are we going to use materiality for? We're going to use it to help us plan substantive procedures. What accounts are important, what is more uncertain, so maybe we have to do more work on them, what areas are more susceptible to errors and fraud than others. We're also going to use it to assess performance materiality. So as we're going through, we need to keep track of all of the uncorrected immaterial misstatements that we found to make sure that they don't aggregate up to an amount that's greater than our materiality. And then ultimately, when we're making those decisions about what kind of audit report we're going to issue, and specifically what kind of opinion we're going to issue, we need to consider materiality. So we would say, okay, we found these things, they did not fix them. Is it material? If it is material, maybe we need to issue a qualified opinion, which again is one of those except for opinions, where we would say, except for the effects of this lease, and we would give the material amount that the lease is off by, the financial statements are in compliance with GAAP. If we feel that it's not just material, but it's what you would call pervasive, so it affects all of the financial statements or multiple financial statements, we would probably say, okay, maybe this is an adverse opinion, or even a disclaimer of opinion if we were unable to perform certain audit procedures that we deemed were material. So we're going to use materiality to help guide us once we get to the end, and if we still have issues, we may have to issue a different type of audit report other than an unqualified report. A couple of other important points. Materiality for the financial statements as a whole needs to be expressed as a specified amount. So you cannot be intentionally vague about what you consider to be quantitatively material. That needs to be expressly specified in the working papers. And then lastly, auditors are required to determine whether particular accounts or disclosures require lower materiality thresholds. So it's often going to be the case that certain accounts and certain types of transactions are more risky, so they're going to have a much lower materiality threshold than a normal account. So a good example of this would be related party transactions. Related party transactions need to be recorded with a high degree of precision, and so we're going to have lower materiality thresholds for that than say we would have for acquisition transactions or payroll transactions. So this is how materiality influences the audit. Next, we're going to talk about audit procedures. And the book gives 8 that they discuss in depth, but there are more than that, and we're going to talk about these. I use, again, the mnemonic 5 carrots to remember all the different types of audit evidence, so we'll talk about each of these. So the use of audit procedures. We're going to use audit procedures for a number of things. One is to gain an understanding of what's going on. So risk assessment procedures. So we're going to perform analytical procedures in the planning phase to get an idea of what's going on. When we're performing analytical procedures, we're going to be looking for, relationships that we expect to see but maybe don't see, or relationships that we don't see but we would expect to see. So we're going to use these to look for the reasonableness of items included in the financial statements, and then if we get discrepancies from our expectations, we're going to investigate those or put more resources to investigating why those relationships exist. So we're going to use audit procedures in the risk assessment process to understand what are the risks for the company. We're going to use audit procedures, obviously, to test control and make sure controls are operating effectively. And we're going to use them to get that detailed evidence regarding the financial statements and the elements within the financial statements and the accounts within those elements. So, substantive audit plan. This is just a list of the procedures we're going to use to gather evidence, including the relevant assertions associated with that evidence that we are collecting. And we're going to do this for all of the significant financial statement accounts. So as I discussed earlier, there's basically 2 buckets in terms of procedures. We have substantive procedures and controls procedures. Substantive procedures are also referred to as test of details. And again, the reason why they use the term substantive is because what they're saying is we're trying to substantiate the amounts that are included in certain kind of transaction or within an account balance. And so there's 2 general ways we can conduct substantive tests. We can use what are called substantive analytical procedures, and we're going to discuss exactly what analytical procedures are here in a minute, or we can do test of details. So there's two general categories. Analytical procedures, again, what we're in general trying to do is we're trying to get a high level or rough picture of what's going on. So we're going to look at relationships between financial statement amounts. So all of those ratios that you guys have learned in your financial accounting classes and in your finance classes, we're going to be using those things. We're going to look at things like inventory turnover and profitability ratios and solvency ratios to look for issues and look for reasonableness of those amounts. Test of details is getting more into, okay, for accounts receivable, the ending balance says it's $1 million, and that's made up of 50 different accounts. How are we going to go about substantiating that that $1 million is the correct amount? And so one of the procedures we might do is send off accounts receivable confirmations. So send off something to the client saying, is this what you owed at year end? That's a different kind of procedure. That's much more detailed testing of the exact amount versus an analytical procedure, which is going to give you a rough idea of exactly what's going on. So let's give some examples of different assertions, evidence that they would get, and the procedures. So your book has this exhibit 3.2, and let's look at existence, for example. So if we were looking at existence, which again is overstatement, one of the questions we might ask related to assets is, do the assets that are recorded really exist? And so you could probably think of a number of different ways we could collect evidence, but one thing that we could do is we can inspect those assets. We can go and actually find them and make sure that they actually exist. If we're talking about rights and obligations, one of the questions that we could have is, does the entity actually own the assets? Do they own the investments that they have on the balance sheet? Do they own the inventory that they say that they have on the balance sheet? Well, one thing that we can do to test both of those is send off a confirmation. So for investments, we could send off a confirmation to the company that's holding the client's investments. If the client actually keeps the investments on site, we can inspect them. And similarly for inventory, let's say that the client uses a third-party warehouser. We can send off a confirmation to that warehouse and say, is this really how much inventory they have at your facility? And is that inventory in their name? So these are things that we can do. These are specific procedures we can do to address key assertions for different items within the financial statements. And so what we need to do as auditors is we need to have a comprehensive list of all the procedures that we're going to do for each account to make sure that we're addressing all of the key assertions for that account. So not every assertion is important for every type of transaction. So for example, when we get to the revenue chapter, we will say that we generally do not perform audit procedures to ensure the completeness of sales transactions. And so if you remember back to what completeness is, it's saying everything that should be recorded is recorded. So you might ask yourself, well, why wouldn't you want to make sure that all sales transactions are recorded? And the answer is, it's not really important for sales. There's not a huge issue with companies not recording revenue. The issue is the opposite, right? What we're generally concerned with is that companies are recording revenue that they shouldn't be recording. And so as we're going through and we're planning, we need to say, okay, for this given type of transaction or for this specific account, what are the risks? What are the relevant assertions? And what procedures am I going to perform to get enough sufficient appropriate evidence to feel good that I can say that that account or that class of transactions has been fairly presented in the financial statements. So the 5 carrots. So footing, cross-footing, inquiry, vouching, examination, confirmation, analytical procedures, reperformance, recalculation, observation, tracing, and subsequent events. And of course we have the 5 carrots over here in the picture. So let's talk about what each of these are. So footing and cross-footing is important. It's verifying the mathematical accuracy of columns and numbers by adding down and across. One of the things that you would be shocked by is how often this footing and cross-footing is not done correctly by the client. And so you might say, well, why is that a separate issue, or why is that important? It's important because let's say that a client gives you financial statements that don't add up. That is to say that when you add the total that they have for current assets with long-term assets do not add up to total assets. And then you issue these financial statements with your stamp saying that they're okay. That's going to be pretty easy to prove that you were not exercising due professional care, because they're going to be able to say, look, this guy didn't even test to make sure that the numbers added up correctly. Can we really rely on the other work that they did? So this seems like a pretty easy thing and an unimportant thing, but it's actually really critical. The more obvious an issue that something could be, or the simpler it would be to test something, the more it's going to be expected that you did it and you did it correctly. So footing and cross-footing is actually a really important procedure for auditors to consider. Inquiry is just written or oral response to questions from the auditor. It requires corroboration to be conclusive. Why? Well, because it's easy for people to lie. So we're not just going to accept what someone says. We need some type of corroboration that what they're saying is true. The exception to that is if there's some kind of a negative statement. So if someone says, yeah, I committed financial statement fraud, we can probably rely on that discussion. And that just goes back to attribution theory and the idea that people are unlikely to say negative things that make them look worse. Then that's more likely to be true, or we would expect that it's more likely to be true than someone saying something positive about themselves or something that would paint them in a good light. The next one is vouching, and this is directional testing from the accounting records back to supporting documents. If you guys learn one thing in this class, I want you to understand what vouching is, and then we're going to talk towards the end what tracing is. And these are the directional tests that we do. So again, vouching is going from the accounting records back to some kind of supporting document. It's going to support the existence and occurrence assertion, which again is overstatement. And you might say, well, why is that giving us evidence on overstatement? This is why. Let's take a transaction like sales. So we start from the sales journal. That's an accounting record, and we identify a very specific sales transaction. If when we go back to the supporting documents, so that should be supported by an invoice, that should be supported by, say, a shipping document, and that should be supported by a sales order. If we go back and we see that there was nothing ever shipped, then that means that they've recorded something in the accounting records that shouldn't be there. They're recording a sale for a transaction that didn't occur. So that would make the sales overstated. So when we go from an accounting record back, it's going to test for overstatement. If we go the opposite direction, if we start from some source document, so say we start from the shipping documents and say, okay, was that recorded as a sale? That's going to be the opposite. It's going to test for understatement. Because if what we're saying is every shipping document should have resulted in some kind of sales transaction, if it's not been recorded, then the account is going to be understated. So the direction matters. And so you guys need to beat this into your head that accounting records back to supporting documents or source documents is overstatement, and the opposite is understatement. Examination, inspecting, and reviewing. This is a really broad category, but it's really looking at actual evidence, and we can do physical examination where we're going to inspect tangible assets, say like trucks or different machinery or equipment. Again, this test existence. It's very reliable audit evidence, but it doesn't always provide the most appropriate evidence because it doesn't give us a lot of information about rights and obligations. So say I go and find the truck, that does not mean that they own that truck. That just could mean that the truck is there. Similarly, I don't know if the truck necessarily even runs well. Maybe it doesn't even have an engine in it. So it does not provide great evidence regarding rights and obligations and possibly valuation as well. Inspection of documents is pretty straightforward. Again, we discussed that there's a hierarchy in terms of documentation, in terms of how persuasive it's going to be. And internal documents are going to be less persuasive than external documents. Companies with effective internal controls, their documentation is going to be more persuasive than companies that have poor internal controls. And original documents are going to be better than copies of documents because copies are easier to manipulate. Confirmation is a situation where we are receiving a response directly from a third party, and the request is going to come directly from us. It's highly regarded. We use it for a lot of different accounts. The problem with confirmations is they can be very costly, and we'll talk more about these when we get to the sales chapter, but they can be very costly and very inconvenient. When it's practical and reasonable, accounts receivable confirmations are required in the United States by GAS. And to be reliable, they must be controlled, and that is to say that we need to be the ones that send off the confirmations, and we need to be the ones that receive the confirmations to make sure that they have not been altered. So, confirmations. So in the United States, we must confirm accounts receivable. And again, we're going to control the mailing and the receipt, and we can also use electronic or email confirmations. Internationally, confirmations are not required. In terms of confirmations, what kind of accounts might we confirm? There's a lot of them. Cash, we'll probably want to confirm. Marketable securities, we're going to probably want to confirm. Accounts receivable, we're going to want to confirm. And who we're confirming them with is associated with where those assets would be at. So for cash, we would want to confirm those with the bank. For securities, we'd want to confirm those with the investment custodian. For accounts receivable, it would be a customer. But we use these not just for assets, we can also do them for liabilities. For example, when we send off the confirmation to a bank, we might both confirm the cash that they have in the bank as well as any kind of note that they have with the bank. We'll often use them for shares outstanding in the owner's equity section. So there's a number of different possibilities for confirmations. And again, they're really useful, but depending on who we're sending them to, they may be really costly and time consuming to actually perform. Analytical procedures. So this again is where we're comparing relationships to assess whether account balances are reasonable or whether we need to do additional things. It's required during the planning and completion phase. And so I've already discussed the planning. You may be asking yourself, why would we want to use this in the completion phase? And the answer is pretty simple. As we go through and perform the audit, we're going to find errors. The client is going to fix those errors. And if enough of those errors have been found, what can happen is by the end of the audit, relationships that you thought were okay are now not okay, and vice versa. So we want to do this at the end of the audit to make sure and look back and say, are all the relationships that we thought should be a certain way, are they still that way? Or is there a new, or has there been a significant change in some kind of ratio that we don't expect to see? Because if that is the case, we may need to go back and do additional audit work. So why are we going to use analytical procedures? There's 4 general reasons. It's going to help us understand the entity. It's going to help us assess going concern. So is the company going to be able to stay in business? It's going to, as I just discussed, it's going to give us some attention directing, what areas require more focus, and we can use it to reduce other substantive tests. So we can use analytical procedures by themselves to do specific testing. So, for example, some accounts have very close relationships or predictable relationships with other accounts. So, for example, interest expense. We can use analytical procedures to assess the accuracy of interest expense, because we know how long the company's had the note. We've already confirmed that they have the note, and we've confirmed the rate. Now we can calculate the interest expense. Sales returns and allowances, something that we can test using analytical procedures. Or depreciation expense, something that we can use analytical procedures to test. And it's the advantage of using analytical procedures is they're less costly than other types of procedures. So here are some examples of analytical procedures that we may use, where the sources of information would come from. So for example, comparison of current year account balances to the balances of one or more comparable periods. Where would we get that information? Well, we can get it from the financial account information for comparable periods. So the example they give is current year cost of goods sold compared to last year's cost of goods sold balance. We could also do comparison of current year account balances to anticipated results. And so you say, well, where would we get the anticipation? How would we know what they anticipated? Well, a good source of that information are company budgets and forecasts. So we can say, okay, what exactly happened versus what did they budget for? What did they forecast for? And if there are big differences, we need to investigate why there are differences. To finish this up, reperformance is exactly what it sounds like. That's where we actually go through and reperform a procedure, like say a bank reconciliation or some kind of internal control to see if it's functioning the way it's supposed to. Recalculation is exactly what it sounds like, and rechecking a sample of calculations. Observation, this is where we're using our senses or we're perceiving what's going on. Observation is going to require corroboration. Why? Because people act differently when they know they're being observed. So, for example, we may go in and the client is performing a control exactly how it's supposed to be done. But in most cases, the client is going to know when the auditor is going to be there. And so people may change their behavior just because the auditor is there. So we need to make sure and find some other way to corroborate whether something is going on other than observation, because the results can be really variable for that. Tracing I've already kind of touched on. That's the directional testing from the source documents to the accounting records. And again, this is supporting completeness or the understatement of errors. If a source document should have resulted in the recording of a transaction in an accounting record, if we go to the source document and it has not been recorded in the accounting records, that means that the accounting records are not complete. Everything that should have been recorded has not been recorded, which would be an understatement error. And then lastly, subsequent events. And we will go into a lot of detail on subsequent events when we get to chapter 11, but we're required to make sure and update our information on the company, not just through year end, but before, as we issue the audit report. So if something important has happened from year end to when we're issuing the audit report, we need to make sure that the financial statements are not affected by that important event, say an earthquake that destroyed one of their warehouses, or the result of some kind of litigation that has now been resolved. We need to make sure it doesn't have an effect on the financial statements. If it does, the financial statements will have to be adjusted. If not, we need to at least consider whether that important subsequent event has been disclosed appropriately. So those are the 5 carrots. So what I would like you guys to understand is what type of assertions or evidence you're going to get from each of these, as well as just a general understanding of what I mean when I say footing. But by far and away, the most important ones for you guys to focus on are vouching, tracing, analytical procedures, and confirmations. Those are by far and away the most important ones I want you guys to focus on. Okay, CATs, computerized environment. So CATs are computer-assisted auditing tools. We need to, when we're working in a computerized environment, consider the impact of that computerized environment on our audit. So information is not always available, so there could be an issue in terms of the transaction trail. What is the potential for errors and fraud in a computerized environment? People tend to think that there's less issues in terms of fraud in a computerized environment, but sometimes it can actually be worse in a computerized environment, because any kind of fraud is systemic as opposed to being just haphazard or random. So we need to consider all the different things, like are they using cloud computing in terms of planning our audit. Okay, so what are some specific things that we need to consider? One is, what is the complexity of the client's computer operations? Some companies have very integrated computer operations. Some have separate computer operations for each different type of transaction, which can be troublesome. What is the organizational structure? What is the availability of data? Again, if data is only retained for 2 days, we can't just wait until year end to try and do all of our testing. We need to be thinking about doing several tests throughout the year. Computer-assisted auditing techniques, we're going to be using one in this class, the IDEA, where we can look at a lot of transactions and perform testing on a number of transactions as opposed to just, say, a sample of transactions. And they also help us identify issues within the data. And then related to that, what is the need for specialized skill within the engagement team? So do we need more IT auditors for a given client? So what are these computer-assisted audit tools or techniques? We're going to use them to access and extract client data. Some different things that we can do. We can look at field statistics to look for highs, lows, average values to see if those make sense. We can do complex recalculations that would be difficult to do by hand. We can join and compare different data files to look for unusual relationships between data files. We can perform much more detailed analysis by performing stratification, where we're lumping similar sized transactions or account balances together, so we can segregate the really high dollar value from the really low dollar value. We can look for things like, is there a gap issue in terms of checks? So they've issued 20 checks and all of a sudden there's 20 that are missing, and then it picks up again. As well as sample selection. How big of a sample size do we need? What exactly are the items that we're going to select? And then lastly, audit documentation. So the purpose of audit documentation is to provide reasonable assurance that we are doing the audit correctly. So it's going to help us in terms of planning. It's going to help provide evidence of exactly what we did. It's going to also hopefully provide a basis for our opinion on whether the financial statements are fairly presented. And lastly, it's going to provide a hierarchical basis for demonstrating that we actually reviewed the work of subordinates. Because remember again, under GAS, we're required to both plan and supervise for our assistants. So what is audit documentation? So it's a written record for the basis of our conclusion to support the representations that we make and whether those representations are contained in the audit report or otherwise. So what are the objectives? The objectives are to improve audit quality and also to enhance public confidence. So what we don't want is a situation where an auditor is issuing an opinion and then someone says, okay, how did you arrive at that opinion? You said, oh, I don't know, I threw it all away. Right? We need to have some kind of basis to make sure that auditors are actually going through and they're doing what they say they're doing. Because the risk is that an auditor would go to a client and say, look, if you pay me $50,000, I'll give you the opinion that you want. And I won't do anything. I won't disrupt your operations. I'm just going to give you the opinion that you want. You don't want that. So part of the way that we make sure that that doesn't occur is we require auditors to document everything that they did. Some important things: ownership of the working papers. The auditor is the owner of the working papers. However, according to Rule 301, the information is confidential, which means that we generally cannot disclose it to people other than the client without the client's permission. Retention requirements for a private company, it's 5 years. Documentation must be retained for 7 years from the report release date or otherwise from the last day of field work for publicly traded companies. You must retain resolution of differences in professional judgments among the audit team. So if you're a staff auditor and you disagree with the conclusion that the manager or partner has made with respect to a working paper that you worked on, you have to document that disagreement. If you do not, and the audit firm is later sued, you can lose your license. It's not enough to say, well, I disagreed with him. You need to make sure and document that disagreement if you continue to disagree with them. All documentation must be finalized within 45 days of the audit report release date for publicly traded companies, and also for publicly traded companies, knowing and willful destruction of audit files within 7 years is punishable by 10 years in prison. And this is really the Enron rule that you can't shred documents. So make sure that you understand who owns it and the confidentiality requirements, as well as the retention requirements for public and private companies. So what are in there? Well, they're what are called the permanent files, which are those type of files that don't really change from year to year. So articles of incorporation, bylaws, stock options, previous analyses such as long-term debt, fixed assets. These are things that are not going to change that much from year to year. Internal control documentation and previous analytical procedures from previous year's engagements. Current files are those things that are going to affect the current year. Hopefully that makes sense why it's called that. So that's going to include the current year's audit program, general information related to the year, the working trial balance, which is a listing of all the general ledger accounts. And that's going to be supported by what's called a lead schedule, which shows how all of the balances are calculated. You know, for example, what accounts roll up into net property, plant, and equipment. That's what a lead schedule is going to give you information on, as well as any adjusting entries that have been made or reclassification entries that have been proposed or accepted by the client. So the documentation requirements, basically you need to create the documentation in a manner that would allow an experienced auditor who has not been right there with you doing the work to understand exactly what you did and why you did it and whether it was properly evaluated by supervisors. So it should allow them to understand the nature, timing, and extent of the procedures that you performed, as well as the conclusions reached, who performed the work, when it happened, who reviewed it. The documentation should also provide a clear link of what you found to demonstrate compliance with professional standards. It should also support a basis for the conclusions that you reach related to a relevant assertion. So again, these assertions are popping their head up. When we're doing our audit documentation, we need to be considering what assertions are we testing and what are the conclusions with regard to those assertions. And then lastly, they're going to be used to provide a clear link that the accounting records agree with the financial statements. That's the biggest thing that we're doing here. We want to make sure that the details link clearly to the amounts that are reported in the financial statements. So probably the best advice I ever received when I was working on an audit is make sure that you understand whatever it is that you're working on, how does that tie to the financial statements? If you can't make that link between what you're working on and something within the financial statements, you shouldn't probably be doing that. So that's always an important consideration when we're working on things. So again, it's an integral part of audit quality. We've just talked about all of these. It provides evidence of due care, the basis for our conclusion, and it facilitates our planning, supervision, all those different things. So what would one of these items look like? So here's an example from your book in terms of audit documentation. So some important features. You probably want to have the company that you're auditing's name there, who did the work, when did they do the work. There are these things called tick marks, and this is just a shorthand so that you can say, okay, this is the specific procedure that I performed. So if you look here, you see this check here next to a bunch of different items. And what they're saying is that check means that the person vouched the paid check cleared with a cutoff bank statement. So this is just a shorthand instead of for each individual thing writing that you vouched that check to the cutoff bank statement. That would probably take up a lot more room. So this is just a shorthand for saying exactly what we're doing. But you're also going to have a cross-reference throughout that say, okay, where does this detailed testing tie up to something else? So all of these working papers are going to ultimately reference up to some kind of lead schedule, and the lead schedule should give you an idea of exactly how the account balances and the financial statements are made up. And so you're going from detailed testing, again, eventually rolling up into the financial statements. Now, two important things that are not here. So one good thing that is here is that it's showing both who prepared the document as well as who reviewed the document. Two things that are noticeably missing for me when I look at this audit documentation is I don't see any kind of purpose statement. So you should have some kind of broad purpose. The purpose of this working paper is to verify, the existence of inventory, or to test for the accuracy of cash in the bank. Whatever the purpose is, there should be some kind of purpose. The second thing that is noticeably missing here is the conclusion. What is this person's conclusion with regard to what they did? Well, it's a little bit tough to write a conclusion as to what you found when you don't have a purpose. It's not to say that it can't happen. So let's look at a different example that has at least a conclusion. So this is a similar thing. They have the client's name. This is a computerized example. Here they're testing notes receivable, the balance sheet date, where's the audit file reference, who did the work, when did they do the work. And again, you see these tick marks explaining what they did, where they're saying they agreed the face amount of interest rate, issue maturity dates to the actual note receivable document. So they're doing the same thing, and they're footing these columns, and they're doing those things. But again, a couple of things that are noticeably missing for me from this one is that they don't have anything saying where someone reviewed it. So what we would also like to see is a separate line where the reviewer could sign off on what they did. And maybe for this company, what the manager would do is put it right next to the preparer. Say, well, preparer slash supervisor, so everyone who maybe looks at this working paper and signs off on it puts their initials here. I'm not sure, but that would be something that you'd want. What you also do not see is any kind of purpose or objective for doing the working paper. More than anything, what this is going to help is with review. So someone coming in who doesn't know what you're doing will know, why did you do this working paper? That is also noticeably missing here. But what is good that they do have is they do have a conclusion. So it says notes receivable balance appears fairly stated. The collectability of all notes was discussed with the controller. Per our conversation, all appear to be collectible. In my opinion, no loss provision is necessary. So maybe an improvement on this would be to have an objective that would say the purpose of this working paper is to ensure that the notes receivable balance is fairly stated, and whether there needs to be a loss provision for notes that are uncollectible. So that could easily be the purpose, and then you'd have the conclusion. So both of these examples have some deficiencies, but you get the general idea. You need to be able to document what you did, how you did it, what exactly you did, so that 10 years down the line, if you get called in front of a jury, you're going to be able to say what you did and why you did it. So if nothing else, it's for you to cover yourself, to jog your memory, but it also helps in the review process. So that is it for chapter 3. There's a lot of stuff in here, and you should look for the homework video related to the chapter 3, as well as the answers to the handout for chapter 3. So that's it for chapter 3, and I will talk to you soon. Again, if you have any questions or issues with chapter 3, make sure and post them. If you don't feel comfortable posting them, send me an email and we can discuss those issues.